Schwab's optimistic investment projections. All right, so this just came out. Just read it today. It's interesting, and I default for the Vanguard because Vanguard is notoriously more on the conservative side. Schwab's got some good stuff in here, so we'll dive into this here real quick, and we'll see if we agree. Our current 10-year outlook highlights better opportunities for cash and bonds, primarily driven by higher starting yields and a steady outlook for stocks. So I completely agree with that. So let's go. After a year of continued rate hikes in response to unexpected persistent inflation, the U.S. Treasury curve remains inverted. All right. Since the yield to maturity of a bond is closely tied to the annual rate of return an investor can expect, these higher yields have resulted in a much more favorable outlook for bonds, offering the most compelling expected return in years. For instance, U.S. government investment-grade bonds, the Schwab, expects to have a 5.7% rate of return over the next decade, over from 4.9 from last year. So that's pretty good. 5.7, a little bit more optimistic than I would do, more optimistic than Vanguard. We expect bond returns to closely align with yield to maturity given the flatter than average curve. So remember, what determines a bond? It's just the bond rate of return over the next 5 to 10 years. It's the current yield. That's it, man. That's it. If you're getting 5% on your current bond, you're probably going to get 5 as a current yield. That's what if it's a 10-year bond, that's what you're going to get. It might be off by 10 basis points. Well, now, how come every time I do a video, it wants to go outside? So bonds are so easy. They really are. Your bond rate of return are going to be your current yield. I'm just telling you, I've done a million videos on this. We look at going back to the Treasury yields from 2013 and where the Treasury market was 10 years later. It's like almost a perfect correlation. What's my expected rate of return on bonds is what the current yields are right now. So right now, 10-year Treasuries are paying, I think they just breached 4% on Friday. Let's see where they are right now. Right now, literally 4% right now. So you'd expect a 4% rate of return on a 10-year government bond. Yeah, I'd probably increase that to 5% on a highly rated corporate bond. 30-year bonds are paying 4.17. All right, so I would say between 4 and 5% on bonds. That's what you should be expecting your rate of return. Not much more, and certainly not much less. All right, now cash a little bit different because cash, come on, it's Fed funds rate determines cash, and the Fed funds rate is very volatile, as we saw in 2022, and I think they raised a little bit in 2023. I can't remember. And so cash, it is whatever the Fed funds rate is. And right now the Fed funds rate is like 5.3, and that's what you expect right now, but that could change in a drop of the hat. So you never bank cash on your current yields. You always bank bonds on your current yields. So I completely agree with Schwab there. 5.7, that seems a little bit high to me. I would say using a 5% rate for, I'd say 4.5 would make me more comfortable for bonds, but that seems a little bit optimistic for me, my taste. Let's keep going. And here they're saying their cash forecast has risen from 3.3 to 3.6 for the next 10 years. A little bit more optimistic than me. I'd say 3%. I'd be much more comfortable if you use 3% as your projection for cash. All right, let's keep going here. All right, let's see. Typically, an increase in prices would mean lower expected returns. So increasing prices happened in 2023 after a fall in prices in 2022. That's where I was a little bit optimistic on stocks. Not as optimistic as they are in bonds, but a little bit more optimistic than I am. Typically, an increase in prices would mean lower expected returns due to a higher and less attractive starting valuation, because we're already buying high essentially. However, the dynamics in the market go just beyond prices. Stock valuations are influenced by cash flows, dividends, and they're also influenced by earnings growth. Despite our long-term growth outlook staying subdued, there's been a positive shift in expected earnings growth compared to 2022. These factors feed our valuation model suggest that any potential decline due to elevated stock price has been counteracted by an improved earnings growth outlook. Yeah, I'm not so sure about that. I'm not so sure. You still got the energy costs we have to contend with. We still got the green agenda on the march. We still have an election near this year, and the Democrats going for blood. And they might get it, man. I mean, we got a lot of issues. Still got a higher labor cost. That's just a fact. We still have wars that the United States, for some reason, wants to get involved in, be it, the Red Sea, be it Israel, be it, Taiwan, and be it Ukraine. And we just don't have the money for all this stuff. I mean, we can print it, I guess, but at the end of the day, if you're going to print the money, why don't you give it to your citizens, for heaven's sake, instead of the Ukrainians? But be it as it may, I don't see that earnings growth is any better now than it was last year. Obviously a little bit less inflation. And again, these guys want to attribute it to the Federal Reserve. I'm like, ugh. But Yeah, very frustrating to me. But, I get that. The higher labor cost and the higher energy costs, man. And we have yet to deal with energy costs. And as long as energy costs are going high, earnings growth is going to be subdued. There's just no other way around that. So let's keep going. They talk about the equity risk premium, and I'm not a big fan of the ERP. So the equity risk premium is the additional return stocks provide over risk-free investment, says this T-bill. And I talk a lot about this in my course that's going to be coming up here. I promise it is. I'm working on it a lot lately just because I didn't like the first take of it, so I'm redoing the whole thing. But let's see. So an equity risk premium acts as a yardstick for evaluating whether stocks are expensive or cheap compared to other investments. This year, the expected equity risk premium is less enticing compared to other decades, primarily due to attributable bond yields, 100%. So right now, you're saying, if I can get 5% of risk-free investment, I can. I would need to get more than 5% in a risk investment, a stock. And that's 100% true. Now, the 5% in a risk-free investment, though, isn't stable. It can go drop at the minute Jerome Powell sneezes. But I am getting that right now, which makes stocks not as valuable to me. I'm not willing to pay a higher price for $1 of earnings in stocks when I can get 5% on a risk-free investment. I can't stress this enough, man. So if you look at stock price performance, it's based on three things and three things only: earnings growth year over year, plus dividend yield, plus or minus PE contraction or PE expansion. PE contraction is simply, man, I'm not willing to pay, like I think, what was I looking at yesterday? Tesla. 75 is the price of earnings. People are like, yeah, I'm not willing to pay $75 for $1 of earnings. Maybe $30 I'd be willing to pay, but I'm not willing to pay 75. And as such, I'm going to start selling some stocks like Tesla. That's PE contraction. On the other hand, people say, oh, Tesla's going to have blowout earnings. The earnings are going to go through the roof, so I'm willing to pay $150 for a dollar of earnings. The historical average is roughly 15 to 16 in the S&P 500. Maybe 20 for growth stocks. I'll be like, okay. But then you always have to ask yourself, as I talk about my course, how does that actually reflect to you as a gain? How do you get paid on your Tesla stock? And I'm just using Tesla as a proxy because the PE is so high. Amazon. How do you actually get paid? Because there are no dividends on these stocks. So how do you get paid? Well, I get paid from the earnings growth through the roof. No, earnings growth don't put money in your pocket. Earnings growth doesn't put money in your pocket. What puts money in your pocket if there's no dividend? Selling the stock. To who? Someone who's willing to pay me more than I paid for it. We call that the greater fool theory. So if you're willing to pay $75 for every dollar of earnings of Tesla stock, you have to be willing to either allow earnings to grow so much that it drives the PE down. So the earnings growth grows so much that now you're only paying $40 for $1 of earnings because the earnings grew so much. But you still are waiting on someone to buy that stock from you. And that's called the greater fool theory. You're waiting on the greater fool to buy it from you. Now, you can make an argument that you'd be the greater fool, me, who I didn't buy the stock because you think Tesla's earnings are going to go so high that's going to knock the price to earnings ratio down to a more relatively lower level, historic level. That's fine. You can make that argument. Okay, I get it. But again, you're waiting on somebody else to buy it. That's the only way you pocket gains in a stock if it doesn't pay dividends, is someone else is going to buy it from you at a price that higher than what you paid. That's it. And so if we're already starting at valuations of $75 for every dollar of earnings, those earnings got to go through freaking balls to the wall, man. And okay, you can expect that, but history hasn't been kind to you. It just hasn't been. On the other hand, if you look at a stock that's got a 10 price to earnings ratio, you know what I'm saying, and it pays a dividend. This is what Exxon was a couple of years ago when I bought it, and I sold it for a 100% gain. It was great, and I bought UGI, and I gave up my 100% gain because UGI subsequently went down 50%. So I basically right back to even. But I did get the dividends. But I got the dividends. But because the valuations were so low to begin with, there was more upside because it didn't take much for Exxon's earnings to go higher and higher. And people said, that's starting to get attractive, especially the dividend yield is starting to get attractive. Because back when I bought, the dividend yield was like 8.5%. I think it might have been 10% the day I bought it because the price was so low and the earnings were so high. So at some point, people say, that's just too valuable. It's too attractive. Low price, high dividend yield, I'm buying that sucker. And they've been rewarded for that. And that's the difference between value stocks and growth stocks. Value stocks give you something you can chomp on. A real piece of cash you can be a finny on that. Isn't that right, boys? Gives a real bite. You can look at those. You see those. He's got these huge pit bull like jaw muscles. You're not. And when he bites you, he's not letting go. You're not getting free. That's what a dividend does. Growth stocks is just upside that you're hoping that earnings will blow through the roof. And what if they don't? Then the price is going to go down. And then there won't be a greater fool. You'll be the greater fool. That's always the risk about stocks that don't have a dividend. So at the end of the day, the earnings risk premium is, am I willing to pay an equity risk premium? I'm willing to pay more for a stock that's volatile over what I can get risk-free. I don't know. Historically, it's been about 4%. And I don't pay much mind to the ERP just because there's no basis of it other than PE contraction or PE expansion, which is based on just how you feel about a stock. It's really that simple. I'm willing to pay you $80 for a Tesla stock for $1 of earnings. And then another guy says, I'm willing to pay you $90 for $1 of earnings for Tesla stock. And if Tesla stock earnings don't go higher, someone's holding the wet bag. That's all there is to it. All right. So they're expected for large cap stocks, and right now their updated forecast, they're expecting a 6.2% expected rate of return for the next 10 years, which is more than they were expecting last year, even though we've had a significant run up for the price. It's just kind of weird to me. I thought for sure their expected rates of return would go down because we had such a big rally last year, but no. And I already told you why. Small cap stocks are expecting a little bit less, 6.3 for the next 10 years versus what they expected last year, 6.5. International stocks, as everybody is, they're expecting higher rates of return internationally. And then bonds right here, 5.7 versus what they expected, 4.9. Again, that's a little bit more optimistic than I like. It's odd that they have an expected increase in rates of return for stocks, given that we had a nice run last year. But, be it as it may, that's interesting stuff. I'll leave the link in the show notes. Let me know what you think. And look, man, I don't want to hear people say the stock market is a Ponzi scheme. The stock market is pure it's just not speculation. I mean, if you're speculating in stocks, you'd be better off speculating and going to freaking playing, whatever the hell it is at the gamble thing, because at least there you got a 48% chance probability. Stocks are literally what employs people. Look at, it's not snow. I thought, do we got snow out there? It looks like a tree's got some ice on that because it's freaking cold, dude. Stock companies literally employs people. Gambling doesn't employ anybody in terms of the actual, I know the casinos do, but the stocks actually move product. There are actually people being employed, taxes being paid, whatnot. Gambling is just numbers, man. That's it. Luck of the draw. That's not with stocks. With that said, should you buy a stock that's trading at a PE of 100? I wouldn't touch a 10-foot pole. There's no way. And but you can. That's speculating, in my opinion. But no, that's not true. That's investing. I think you're speculating on earnings growth, and I'd just be careful of that. But that's okay. You can do that. I mean, I own VTI, the total stock index, so I have some Tesla. I have some NVIDIA. I have all this stuff. I wonder what NVIDIA's PE ratio is right now. Let's take a gander. Shall we gander? Because remember, everyone bought NVIDIA last year based on the explosion of earnings. NVIDIA, NVDA. So 68 PE. Look at that stock. Just come on, man. A 68 PE, and it pays a 3 basis point dividend yield. Man, that's just freaking gone. Look at that. If you would have bought NVIDIA at 30, you could buy it at 33 in March 2019, and I was at 514. That's crazy. That's cool, man. I mean, it helped my S&P 500. Amazon PE is 77. Look at that. There's that comeback from Amazon right there. See that large dead cat bounce right there? It fell like a freaking brick in water and it came back from 2022 to 2023. Let's look at Tesla. Tesla. Excuse me. TSLA. Used to be an old band called TSOL, the Sons of Liberty, old punk band from, I'm sure they're from Boston. I can't remember. So every time I type in Tesla, TSLA, I'm always thinking TSOL. You can see Tesla's big run and big drop, and then run up again and whatever. Who knows? But that's got PE of 76, no dividend yield. Let's look at Microsoft. These are the top, the significant, what do they call this? The Magnificent Seven, Microsoft's got PE 35. There's that run right there. And you can see the drop in 2022 and then the run of 2023. And it pays a dividend of 82% of less than 1%. And Google, G-O-O-G, and Google Alphabet. Again, see the drop in 2022 and then the run back up in 2023. Now, it's only got PE ratio 26. It pays no dividend. And the other one was, we talked Amazon, Facebook maybe? I don't know. Was it Facebook? FB. Meta. Look at that. Look at that freaking drop. That's crazy. Look at that. Just got crushed. Went from 387 in August 2021 to freaking 93 in October 2022. I mean, it went down 75%. And now it's come back. I mean, it's crazy. Look at that. It's only got PE ratio 31. There's no dividend. Anyway, that's nuts, man. All right. That's all I got. I love your thoughts. Put in the doobie-doo. We'll see you.